So the first thing is to tighten up your unit economics. So what you need to basically do, and I'm going to walk through an example of how you would do this with like a B2B company and a B2C company right now, but you need to do a really deep dive on your post marketing unit economics. So obviously the first order and your sort of customer lifetime to understand your payback dynamics and so what you need to do next. So let's kind of walk through two different types of businesses and we'll chat through sort of how you should be doing this analysis and then how you should be thinking about what you can change at this moment. So, first off, this is a B2B SaaS startup. So, a business that the customers pay a subscription, they have a very long customer lifetime, but the customer acquisition cost is probably very high. So, let's say the first order, so the monthly subscription cost is $3.99, but in this situation, the customer lifetime we're saying is 29 months on average. And so this is the lifetime revenue. So let's just look at the first order of a customer lifetime. So the customer pays $3.99. Then we have customer service, software, and hosting. So these are the three elements of their cost of sales. And so the gross profit on that first month is $291 at a 73% gross profit margin. Let's say CAC for this business is $3,500. So you need to basically pay that up front, even though your customer in the first month is only going to make about $300 of gross profit. And that the payback period is around 14 months. So that means that a customer needs to be in the business for about 14 months to generate enough gross profit to pay back the CAC. So after 14 months, then your customer is basically profitable for the company, but through those first 14 months, you're effectively just recouping your marketing costs. So when you acquire any single customer, you lose $3,200. So in a strong fundraising environment, you can raise money to fund this type of customer acquisition. But if the fundraising dries up, this all of a sudden becomes a much more precarious situation. So the lifetime of this customer, if we kind of move through this, is $8,400 of lifetime gross profit. So this is called your customer lifetime value. And so by month 29, you will have basically, made 8,400. In the first month, you basically paid 3,200. But by month 29, your post-marketing margin is about $5,000. The issue is that you lost a bunch of money for the first year. And so this is the thing that we want to tweak right now. So first thing is that you want to consider your pricing. So if you raise your pricing by 2x, how many of your customers would drop? So with B2B companies, this is a really important question. Like if you could double your pricing and you lost a quarter of your customers, that would be worth it. And so you need to really figure out how can you get to break even or how can you burn less cash? And so that's a question you should ask yourself. Optimize, cut costs. So negotiate with vendors, look for alternatives, run as lean as possible. So go through your COGS, figure out what you can cut, figure out what you don't need, figure out if you're not going to grow as quickly, how big of a customer service team do you need? You need to try to figure out how to get your gross profit as high as possible. Because ultimately, at the end of the day, you're trying to increase your post-marketing your post-marketing gross margin. So this number, you can't be burning $3,200 every time you acquire a customer. So you need to figure out how to get this number lower. And the last thing is you need to focus on lower CACs. So focus on your organic channels, focus on the cheaper paid channels, just the lowest hanging fruit. We're going to talk about this in a sec, but probably you want to slow your growth down and just focus on customer acquisition if it's cheap, and if it's expensive for now, do not focus on those channels. So if you're a D2C e-commerce startup, you're going to have a very different customer. So we're saying that our customer lifetime in this situation is basically 2.1 lifetime purchases, whereas a SaaS company could be, 29 purchases. So these businesses have very different payback dynamics. So let's say your first order is $115. You have your product, fulfillment, and customer service. Of course, you're going to want to go through every single one of these categories, figure out what you can do on the product side, the fulfillment side. Can you open up another warehouse? Can you renegotiate with the shipping company? all of this different stuff. Do you need the customer service team to be as big? Can you hire in a different geography? So do everything you can to increase your gross profit margin. And let's say your CAC is $80. So when you acquire a customer in this business, you actually only lose $6. So the customer acquisition uh, payback isn't as precarious as sort of a B2B company. So you don't really burn money when you acquire a new customer. So to the extent that your CAC was higher than 80 and you needed to basically burn a lot more, you'd have to kind of focus more on the lower CACs and lower growth. But a business like this can kind of keep steady and continue to acquire customers as long as they're not burning a lot of money on the sort of first order. So the customer lifetime in this case would be about 2 lifetime orders. This is the customer lifetime value, which is the lifetime gross profit, $155. And so for a business like this, once they acquire a customer, their payback period we're saying is within about 3 months. So kind of once they cross that, you get into this profit zone, and that you actually make about $75 of profit on each customer. So a business like this should actually be continue to acquire customers if they can maintain these CACs aggressively, because they're actually going to be making more profit on more customers. So really depends on your business model. All of the same things would apply. Can you look at your pricing? What can you do on the cost side? Potentially you should be focusing on the cheaper channels, the organic channels, more email, less growth, and just try to optimize your margins right now. So a lot of focus should be on your gross profit margins.